If you've ever received a Form 1098-T that looks like this, where the scholarships total more than the tuition payments received, you might think that you don't qualify for an education credit. Well, if you have a certain type of scholarship, you might be able to claim an education credit after all. I'm the Tax Geek, and here is how to report scholarships as income, oversimplified. This video assumes you know how education credits, particularly the American Opportunity Credit, work. If you'd like a refresher, check out the video shown in the card above, which is also linked in the description. In general, eligible expenses that can be used to claim an education credit is the difference between the payments received by the institution and any tax-free scholarship assistance received, as shown on this Form 1098-T. You can add to this any cost for books and equipment when claiming an American Opportunity Credit. Scholarships or other financial assistance to education can be divided into two categories. First, a restricted scholarship is a scholarship that must be used only for the eligible education expenses of tuition, fees, books, and equipment. But scholarships can also be in the form of unrestricted grants, which can be used for both eligible education expenses and additional living expenses, such as room and board or off-campus living arrangements. The most common type of unrestricted grant is the Pell Grant, but there are others. The IRS considers scholarships to be taxable income unless they're used for qualified educational expenses, which almost all of them are. If they are taxable, they are considered to be unearned income to the student who received the scholarship. But with unrestricted grants, a student can elect to designate the scholarship as taxable income and pay tax on it. Why would a student want to do that? Because doing so would free up eligible expenses that can be used to claim an education credit, or increasing one that is already claimed. Let's see exactly how this works, using a couple of examples. Alvin, a 26-year-old single taxpayer with no dependents, decides to go back to school to finish his undergraduate degree. He meets all the requirements for claiming an American Opportunity Credit. Alvin also has W-2 income of $22,700. Alvin's 1098-T shows $12,750 in tuition payments received by the university. The scholarship total of $13,500 shown on the 1098-T includes a restricted university scholarship of $7,500 and an unrestricted Pell Grant of $6,000. At first glance, it might seem that Alvin would not be able to claim an American Opportunity Credit, leaving him with a tax liability of $885. But if he designates $4,000 of his Pell Grant as living expenses and declares it as taxable income, his tax liability increases to $1,325, but now he has enough eligible education expenses to claim a full American Opportunity Credit. He uses the non-refundable portion of the credit to reduce his tax liability to zero and receives the refundable $1,000 credit as a refund. So whereas before he had a tax liability of $885, he now receives a $1,000 refund, putting an additional $1,885 in Alvin's pocket. This can also work with parents who claim the American Opportunity Credit for their dependent children. Let's look at Marianne and Darren, whose son David is a full-time college student. As you can see from this Form 1098-T, David's scholarship, which is in the form of an unrestricted Pell Grant, equals the $8,500 in tuition paid to the university. Marianne and Darren's joint adjusted gross income is $125,000, and they claim the standard deduction. Again, at first glance it doesn't seem like there are any qualifying educational expenses to generate an education credit for Marianne and Darren, giving them a tax liability of $11,527. But look what happens when we designate $2,500 of the Pell Grant for living expenses, and have David file a tax return and report it as income. Why just $2,500 and not the maximum $4,000 in expenses allowed for the American Opportunity Credit? Simply put, since a taxable scholarship is considered unearned income, $2,500 is the most David can claim without triggering Kiddie Tax. If you don't know what Kiddie Tax is, there's a video on that very subject that you can watch by clicking the card above or the link in the description. David then files a tax return, reporting the scholarship as income. The first $1,250 is his standard deduction, and the remaining $1,250 is taxed at 10%, giving David a tax liability of $125. Now, $2,500 is freed up and can be used as eligible expenses that Marianne and Darren can use to claim an American Opportunity Credit. Remember from my video on the American Opportunity Credit that whomever claims the exemption claims the credit, regardless of who actually pays the expenses. This gives Marianne and Darren an American Opportunity Credit of 100% of the first $2,000 of eligible expenses and 25% of the next $500 in expenses, resulting in a total American Opportunity Credit of $2,125. Subtracting the $125 in taxes paid on David's scholarship income results in a net tax savings of $2,000. Unless you think the IRS frowns on this maneuver, the IRS actually encourages it when it is appropriate, as shown on pages 16 and 17 of Publication 970, Tax Benefits for Education. A link to this publication is given in the video description. Scholarships are reported as taxable income on line 8R of Schedule 1 and ultimately show up on line 8 of your Form 1040. Here's David's Form 1040 as an example. Of course, there are additional details to this strategy, especially where Kiddie Tax is involved. The relationship between this strategy and the Kiddie Tax will be explored in another video. If you found this video informative, give the video a like and share it with anyone else who could find it useful. Subscribe to the channel to see more oversimplifications of our overcomplicated tax system. And as always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.